Hello and welcome to today's RRC webcast, The Financial Crisis Solvency Lessons for Today's Environment. To receive a copy of today's presentation, please send a request to reply@riskreg.com. To ask a question during the meeting, type your inquiry into the Q&A panel to the right of your screen. We will respond to all questions after the session as time permits. To answer polling questions, click on the radio button to the left of your desired response, then click Submit to record your response. For technical assistance, click the Help widget at the bottom of your screen. Today's presentation will be recorded. For CRE eligibility, log into the webcast with your first and last name and email address. Remain on the webcast for a minimum of 50 minutes. Participate in polling questions, 80% response required. To answer a polling question, click on the radio button to the left of your desired response, then click Submit to record your answer. You do not need to have the correct answer, but must participate to receive credit. Complete the course participation survey. For attendees participating in a group, designate one proctor to log in as an individual on behalf of the group and complete and submit the group sign-in form within 24 hours of the event's conclusion. The form can be downloaded from the resource list on the right of your screen. Complete and submit the course participation survey. The form can be accessed from the resource list to the right of your screen. One CRE credit will be issued to eligible participants within 30 days. RRC will not issue credit if all criteria are not met, without exception. And now I'm going to hand you over to Jennifer, your host for today.
Thank you, Nikki. Our first presenter is John Humphries. John has over 25 years of experience working with state insurance departments on examinations and regulatory projects related to life, health, property and casualty, and managed care organizations. He leads a team on NAIC risk-focused statutory exams with a strong emphasis on making the exam process effective and efficient. And John also provides training to state clients and trade associations on relevant industry topics. Our next presenter is Neil Miller. Neil has over 25 years of experience in insurance financial regulation with a focus on insurer solvency. He serves as ROC's lead financial analyst, focusing on assisting states with financial analysis, complex transactions, special investigations, and challenging solvency situations. I will now turn the presentation over to John Humphries to go over our objectives. John?
Yeah, thanks, Jennifer. Yeah, and John Humphries here. And just as we get things kind of kicked off, I just want to take a quick moment to say it's really nice to connect with everybody on the call today. We thank you so much for joining us on the call. The objectives of our call today, we're going to talk a little bit about the 2008-2009 financial crisis. We want to try to understand that crisis, some of the things that led to that, some of the things that occurred during that crisis, and some of the impacts. And again, we're going to try to tie this back closely to what was the impact on the insurance industry, specifically the U.S. insurers that we, collectively as a group are responsible for and regulate. And we want to try to take those situations, what happened in the crisis, what we could learn from it, and then try to bring that forward to today to talk more about what lessons could we have learned from that crisis, what are the things that we can apply to the situation that we have today with the COVID-19 pandemic, and really kind of in a way helping us think about these risks and issues as we think about regulatory responses as well. And to kind of set the stage for this, I have a quote up here. This is Winston Churchill. Many of you, I'm sure, have heard this before. In fact, as I was doing a little research, I realized this actually didn't even originate with Winston Churchill. There was a George Santayana who first said this, a Spaniard who had said this in 1905. It was repeated by Winston Churchill in an address he made to the House of Commons. And what he said was, as you can see on the screen, those who fail to learn from history are condemned to repeat it. And to me, this was very appropriate because the situation that we're in today is one of, we want to try to learn from things that have happened in the past, apply those lessons learned to things that are happening today, so maybe we're not condemned to repeat some of the mistakes of the past. So I think it's a good way to get us kicked off for the session today. One other quote that I just wanted to bring up, this was one that Neil had, I guess you'd say, had discovered, and I thought it was great. We don't know who said this, but recessions uncover what auditors do not. that's another outcome of events like this. When we come into this, we talk all the time about stress case scenarios and things like that when we talk about projections. Well, in a way, what we're experiencing today is a stress case scenario, and that stress case scenario that we all are going through is going to point to some of the weaknesses, some of the deficiencies that maybe have been present in the systems already, but they weren't uncovered until today under the stress kind of situation that we're running into today. Now, that does not necessarily mean that the auditors missed it. They may have done the best they could with the information that they had and things of that nature, but regardless, the situation we're in today is a stress scenario which will uncover weaknesses and deficiencies that are in the system. So we like this one so much, Neil and I came up with our own corollary that recessions, like we're in today, are going to uncover what examiners and analysts do not uncover as well. Again, not that we made a mistake, but bringing it home to us as examiners and analysts, the situation that we find ourselves in today with this kind of, stress of the COVID-19 pandemic, coupled with the stress it's putting on the industry, it's going to uncover things that we maybe didn't realize in the past. So we want to cover those things today. And so with that, it brings us to our first polling question number 1. And the first polling question is, which of the following most closely describes your current role? Are you A, a financial examiner, B, analyst, C, market reg examiner, D, actuary, E, other? Again, no right or wrong answer. We do need to have you fill out at least 80% of the questions, and this is very helpful to us to know who's in the audience as we go through the presentation. So if you would, take a moment and fill in your answers. Okay, well, very good. It looks like we have a good turnout with examiners, analysts, even some market regs and actuaries. Okay, well, very good. We have a good group here. And with that, I will turn it to Neil.
Thank you, John. Great introduction. And I would take a moment to thank everyone for joining us today. John and I and RRC truly appreciate you taking the time to discuss with us a topic that's really near and dear to our hearts. So as we start a look back, it's important for us to do this because the crisis really provides a unique opportunity to understand and respond to challenge, or understand how challenging events happen and to respond to those events. And the basic topic here is that bad things happen. This is not an unusual or a unique thing. In fact, we're in the midst of one of the defining unprecedented events of the century that joins 9/11 and the financial crisis as really kind of black swans for the economy and for the world. But we learn from these things and we try to get stronger from them. So as we go through today, we're going to start taking our look back by looking at the financial crisis and how it demonstrated how economic downturns unfold and the impact on the economy and insurance companies. We're going to discuss how many of us contributed to the financial crisis, how U.S. businesses operated in a manner that left them ill-prepared for the burst, and discuss how the housing bubble impacted really the entire economy. So when we start talking about this, the first lesson I learned from the financial crisis is that these things don't happen all at once. They really happen in phases. So, if you think about the way the coronavirus pandemic has impacted first as a health issue, then as a financial issue, you can begin to see what I'm talking about. And really, you think about delays. One of the last entities to get hit in these is government. As the economy slows down, tax revenues decline, government gets impacted by that. And then you also have, in the case of government, sort of the dual impact of just when revenue declines, demand goes up for their services. They tend to get stressed, and they tend to be the last entity hit and the last entity to emerge from these type of events. Another lesson we learned is that what happens in the local and global economies and the insurance markets will impact the insurers we regulate. And part of that is it's easy not to not identify risk from interconnectivity and correlation. And by that I mean, sometimes when we look at insurance companies, we think about risk as maybe limited to a company or to a region. But for example, in the financial crisis, what we learned is for example, the housing bubble was thought to have, or housing was supposed to be regional in impact. It would slow down in one region, not the other. What we found is that the housing bubble and the resulting burst was actually something that impacted the economy all the way across the United States. And the same thing is happening with the pandemic. We've seen maps. We've seen how this thing spread from, theoretically one region in China throughout the entire globe. And you could see it spreading in the United States from state to state, from county to county, and town to town. And when you think about that, who would have believed 6 months ago that all kinds of events would be canceled, all kinds of flights would be canceled, that we'd be staying at home, and that businesses would be largely shuttered. Another lesson we learned is that the operating environment changes can have significant impact on, for example, one line of insurance business. If you look today, you can see the automobile line actually is positively impacted in the short term with less people driving and less accidents occurring. At the same time, things like event cancellation insurance have realized losses that are really unprecedented in scale. These events can also impact one or more types of insurers. For example, life insurers face a significant risk now from mortality, where health insurers are seeing a benefit in sort of the non-necessary type of or less necessary type of health care that's being foregone at this time, at the same time that they're seeing an uptick in claims from COVID patients. Another thing we learned is that operating environment changes tend to impact insurers across their entire operations. Insurance companies are intimately interconnected throughout the economy. In their investments, they have investments in government, both federal, state, local, special revenue type issuances, and also in many of the businesses in the world. At the same time, through their ensuring the risks of the individuals and businesses, they're interconnected throughout the economy. And another lesson we learned is that aftershocks are common and long-lasting. With these types of events, you get a significant amount of uncertainty. And so you see tremendous amounts of volatility in the stock market. You see businesses with the inability to immediately begin operations or delays in operations as other businesses that they do business with are working their way back in operations, things like that. And I think the most important lesson we learned from the financial crisis is that risk management and corporate governance is really critical. At the time that the financial crisis happened, I think risk management, corporate governance, of course, have been around for decades, but it was really in the insurance industry, for example, really sort of underdeveloped and emerging as a critical thing. It's certainly the risk-focused process at that time was emerging as a way to view insurer risk. And over the last decade, both insurance companies and regulators have really embraced this as a way to effectively manage the operations and effectively regulate. Next thing I'd like to talk about is that many of us contributed to the financial crisis. I know that's sometimes a little bit painful to have the finger pointed at myself and others, but that's the way it was. In that, in the years leading up to the financial crisis, I think at least the people that I knew that I talked to about this, a lot of them, right around the turn of the century, had begun to realize that they had forgotten or failed to really plan for retirement, and were looking ahead toward the retirement, saying, I don't have the money to do that, and I need to get there. And so there was a really concerted effort for people in my generation to really start saving. At the same time, you saw things like a hot job market. The stock market really took off, although there was dips in it. And there was things like jobs were really easy to come by. Sometimes the business owners control wages and employment. In this case, there was a high demand for employees and an easy ability for people to jump from job to job and to get higher wages. So at the same time, as people were saving and generating savings, they also had a shifting of goals where they started to look around and say, you know what, I'm starting to get some money here. Maybe I deserve to take some time off and enjoy life. So you saw people start to buy things, started to borrow things. Like in my area, you saw a lot of boats, a lot of trailer homes, the camper homes, jet skis, larger cars, all kinds of things people were spending money on. And then later on, you start to see people say, well, you know what? One way to generate income is to buy another home. And so people would either buy a new home, a larger home, and rent their house out, or they would buy a house for rental purposes. And you'd see a lot of second mortgages, people getting mortgages on their new homes. And the result of this all was a lot of households that were over-leveraged and ill-prepared for the burst. At the same time, businesses were in many ways growing in just leaps and bounds, often fueled by the spending of consumers. And as that happened, you saw an increase in administrative expenses, a lot of inadequate cash reserves, illiquidity in the businesses, and really businesses that became over-leveraged and vulnerable in the event of an economic downturn. And if you think about a really good example of that, think about Ford Motor Company. That was a company that was catering to consumers. That they really focused on their high volume, larger vehicles. And at the end, when the financial crisis actually hit, the bubble burst, and people's spending changed, Ford Motor Company had to do a significant retool of their operations because they were no longer making the vehicles that people wanted or could afford. So, John.
Yes, and so our next polling question is number 2. Which prior financial crisis do you feel the COVID-19 pandemic most resembles? A, Tulip Mania, 1637. B, South Sea Bubble, 1720. C, Wall Street Crash of 1929 and the Great Depression. Or the financial crisis, 2008-2009. Or E, this is new territory. So if you would, put in your entry and we'll see the results. Okay, very good. Not surprisingly, we have an awful lot for E. This is new territory. I'm probably in the this is new territory camp myself, although I can see a lot of arguments for C as well. Anyway, so thanks very much, and back to Neil.
And great, and whoever picked Tulip Mania, give me a call. I'd love to talk that one through. So we're going to start talking now that we've talked about some of the lessons we learned and some of the impacts from the crisis. We're going to take a look back at really what it looked like in terms of the stock market, the housing market, employment, and government. And before we do that, just a moment, I think what's lost in that, if you're looking back in the textbook, you can see what it looked like, but what it felt like, I think, was even more critical. I think you had a lot of people all at once losing their jobs. They might have lost their houses, they lost their income, they started to lose their savings. Really, in a lot of ways, you lose your sense of identity, and it just felt like it was going on and on and on. Every week, the news got worse, the impact got worse, and it just seemed like there was no end in sight. And I think sometimes when you think about things like the pandemic that's going on today, sometimes you feel that way. Different cause, different effect, but still that same sort of uncertainty and lack of control that is so important in these situations. So if we look at the stock market, I like to follow the S&P. That's something that's fairly easy to track. And you can see this is a snapshot from January 2006 to December 2010. As you go across, you can see pretty steady growth, and then you start seeing some hiccups in the stock market. And that to me is when people started to doubt whether or not the value in the stock market was actually true, and you started to see articles appear about, hey, we've got this housing bubble, it's unsustainable, and then in 2008 you saw this cliff that things fell off, and the end result was that in 1 year, just over a year, you lost 55% of the value in the S&P. A typical week would look like this, where you had, over the course of that week, a 7% loss in value. Not the worst week, but kind of typical, and just a steady decline during that period. Just looking at the S&P from a 10-year perspective, you can see two things here. One of them is the 9/11 event to the left, and just past that, you can see quite a bit of uncertainty and volatility. Even as the economy tried to recover, you could just see periods where it just wasn't. People just weren't sure whether stocks were good at value, whether the economy was going to pick up, et cetera. And then to the right, you see that hiccup again, where people started to question the housing market and the bubble and other financial things that were going on, and the cliff. So if you look at this globally, to me, this is just shocking. When you add all the stock markets together across the world, you see a 50%, a $30 trillion loss in value in 1 year. And that to me is really telling about what this crisis had, what the impact it had just across the globe. But what's equally interesting is if you look to the left, you see a period of tremendous growth. And if you look from all the way to the left and all the way to the right, over time you see a fairly steady growth in stocks. However, major hiccups along the way. So if we turn now to housing, and I don't think it's important to really understand what's going on in this, but I think it is visually very, very representative of what happened in the market. To the left, you see housing prices pretty well being consistent. A lot of correlation between markets, because there really wasn't tremendous volume change or changes in the value of homes. And then in the early 2000s, you see a tremendous growth and a diversion as different regions heated up, and the value of homes in those markets, either existing homes or new homes, grew. And to the far right, you can see the impact of the bubble burst when housing prices really plummeted. But what's interesting, too, is while you see diversion, you also see a lot of correlation between regions as the housing bubble really happened across the United States. And the overpricing, or at least the perceived overpricing, is really seen in the years after the financial crisis, when you look at the sales of homes and you see that, for example, in 2012, 2013, about 35% of homes that were sold at a loss compared to their purchase price. And when you think about the housing bubble, a lot of people think about 2007, 2008, 2009. There was actually aftershocks quite a bit after that for a lot of reasons. One of them is it just takes time to foreclose and repossess a house. People didn't lose the ability to pay on their mortgages all at once. And also, a lot of the products that you saw developed in the early 2000s were designed to help facilitate and fuel the purchase of homes. And they had interesting characteristics in there. For example, they would have low interest rates, teaser rates, that were very popular at the time. And those rates would reset at some point in the future. So you have a low rate you could afford, and the idea is that you would be able to either refinance or you would get a more income or something to cover a higher rate in the future. And in other cases, these loans have balloon features so that you would pay little or nothing on the loan, but they would all come due at some point in the future. And so a lot of those loans were bound to default, but they didn't default until 11, 12, and 13. So if we turn now to employment, if you look at COVID-19 in the news, a lot of people are hoping and praying that what we're going to see is a V-shaped change in employment. In other words, some people are going to lose their jobs, but whenever we reopen the economy, those people are going to immediately be able to return to work, and the unemployment rate will plummet. That's not what happened after the financial crisis. There was a really quick decline in employment, and the recovery of that just took years. And you think about the way different businesses are connected to others, it really makes sense. If my client is not open or my customer is not open, I can't hire someone to meet their needs. So let's take a look at just a representative state, New York. And you really don't have to know the details here except for to realize that blue is bad. So the lighter the colors, the better employment is. So this is before the crisis, December 2016. A little bit of uncertainty, but still a hot time. Let's go to December of 2009, and you can see widespread unemployment across the state. It doesn't fully represent what's going on, because if you look at the bottom, a lot of the people that work in Manhattan actually reside in Connecticut, New Jersey, Pennsylvania, even further away. So the impact of unemployment in the job market in Wall Street really is felt regionally, but not really depicted in this map. So let's look at 2016, and you can see we turned a lot lighter in color, but still not nearly where we were back in 2000 or not quite where we were in 2016. So again, it takes a long time for these things to recover. Let's talk about government for a minute. So, this particular slide, I think it's representative. I don't know if it's totally accurate of government revenues just because of the way the government works. But I think it is directionally accurate in that it shows in a 2-year period a 10% decline in government revenues, and it really is the kind of thing where the tax revenue from sales tax, income tax, et cetera, declines a little bit after the original event usually, but it takes a while for that to recover. And at the same time, as we mentioned earlier, you have a tremendous demand coming up as people lose their jobs and need things like welfare and Medicaid. So a really bad time for government as they react to these events and try to meet their needs with a diminished revenue base. So John, we're to the point of our third polling question.
Yeah, very good. So that brings us to polling question number 3. And our question here is, which government COVID-19 pandemic response do you think will have the longest duration impact in the United States? Do you think it's going to be A, shelter in place, B, deferment of student loans, C, the $2 trillion stimulus bill, or deferring mortgage payments, or E, other? So if you would please put in your answer. We'll take a look at those in just a second. While you're putting those in, we've had a couple of people who said they may have missed a polling question because they were knocked offline or something like that. If you can just let us know if there was a technical issue that prevented that, etc., we'll be sure you get credit. Thanks again. And we'll look at these responses. Okay, yeah, I can see that very closely. I'm in the same camp. I'd have been right between A and C. They both are very kind of hand in hand with a huge, huge impact. So good things to think about. Okay, and back to Neil.
Okay, thank you, John. So we're going to now that we've had a chance to think about what it looked like, let's think about and talk about how U.S. insurers fared during this. And one of the numbers I saw that really stuck with me was 424, and that's the number of banks that had failed at a point in 2009. And that compares extremely poorly with U.S. insurers, which largely survived the financial crisis intact. I think that's a combination of a lot of things. One of them is the nature of our operations as insurance companies is different than banks. but it also speaks to the diligence and the creativity of the financial regulators who did a lot of things to identify and address critical issues that were emerging with insurance companies, but also did some very creative things like change DTA accounting and changing the way certain reserves are calculated in order to help insurers through this process. The insurers largely survived. However, the crisis did expose risks in poor corporate governance management, and in particular, the non-traditional insurers that we'll talk about in just a minute were particularly hard hit. It's interesting, as you'll see, that each of these three industries, the non-traditional insurer industries, had the same basic cause for the issues. That was the housing bubble, but they had different impacts, and the risk emerged in different ways. And finally, we'll talk about the traditional insurers that largely, again, survived intact, but they had some significant issues that had to be worked through. So let's talk about how the U.S. insurers, non-traditional insurers failed. And by that, we're talking about the mortgage guarantee insurers, the title insurers, and the financial guarantee insurers. So let's start with the mortgage guarantees. So their insurance products, they're insuring loans against default, and generally they're covering the banks that issue the mortgages. And they had a business model that really, because they insure mortgages across the country, they thought that perhaps performance in different markets wasn't correlated, and as we've discussed, it really was. If mortgages in this situation had defaults in, say, Detroit, you were also going to have defaults in maybe Stockton, California. Another issue that they had was a large reliance on the bank's loan origination processes, maybe a failure of the mortgage guarantee insurers to re-underwrite and ensure the loans were proper for their underwriting standards. The title insurance companies, they typically insure against faulty title when you buy your house. One of the issues they had, though, is they also insure through closing protection letters the escrow funds that are deposited with the title agents that handle the loans. And so you had a situation where a lot of money was sitting in the hands of escrow attorneys, and there was a reliance on the integrity of the loan settlement and escrow fund processes. And unfortunately, what happened is a lot of the people that were holding that escrow funds decided that was a good source of money for them to go out and buy some of the consumer goods that were readily available out there. For example, in one state I'm aware of, there was over 300 escrow agents that were under investigation for stealing escrow funds at that time. And the third non-traditional were financial guarantee insurers that traditionally insured general obligation and special revenue bonds issued by municipalities, but they also got involved in insuring structured finance debt. That would be debt like CDOs that are that the underlying security of those are assets, for example, automobile loans or credit card loans, but also mortgage loans, either prime or subprime mortgage. And it turned out that, again, just like the mortgage guarantee companies, because the performance was based on the assets that were correlated across the country, when issues emerged, they really hit the financial guarantee companies hard, even in the super senior tranches that they insured. And again, they had relied on banks to not only originate the loans, but also originate the securitization packages that they insured to their detriment. So this is a snapshot in 2008 of what the mortgage guarantee insurers' results look like. Certainly losing $1.6 billion in 1 year if your rating guarantee is not the result you'd like to take to your board. Pretty significant loss that year. What's neat, in each of these entities is required to maintain a contingency reserve, and the regulators work with management to release some of that contingency reserve that's put up just for these situations, and really creatively worked with these companies to help them to get through the crisis and survive. Title insurers, while the losses are lower than mortgage guarantee, they're certainly significant to the entities. If you look at, for example, lawyers, they lost more than their ending surplus in 2008. And if you think that's bad, let's take a look at financial guarantee insurers. This is an industry that was almost completely wiped out by the financial crisis. I think Assured Guarantee is the only one of these entities that's still operating today. If you look at some of these losses, Secure Guarantee with a $2.3 billion surplus deficit and a $4.8 billion loss kind of stands out as representative of the losses that can happen when you're insuring huge amounts of business. So turning away from the non-traditional and back to the traditional insurers, these entities had a lot of hidden risk that emerged during the financial crisis, particularly things like investments in residential and commercial mortgage-backed securities, things like securities lending programs that had bad collateral, a lot of issues that regulators identified and helped the companies work through. But one of the questions that was raised to me at the time is, what if this is the new paradigm? If this is the way investments really work out? So this company ended up with, at the end of 2018, with $800 million of surplus, largely because of a $355 million capital contribution during the year, and just a modest net loss of $284 million, but enough to get your attention. But let's take a look a little bit deeper. So this is a chart depicting the unrealized losses in their investment portfolio at the end of 2008. And as you can see, the bottom line here is, while they had $800 million in surplus, they had a almost $2.3 billion unrealized net loss on their fixed investments. So a lot of that was in corporate-backed securities and insurer obligations, but a lot of investment in RMBS and CMBS. And even, while they may be less big in terms of dollars, certainly big in terms of unrealized losses. Luckily, this particular entity was able to hold those until maturity, but if they had not bounced back, that company would have been dead in the water. So, John, I think that takes us to our next polling question.
Yeah, absolutely. Thanks, Neil. Yeah, polling question number 4. Which insurance segment do you think will see the biggest impact from the COVID-19 pandemic? Do you think it's going to be most impact on A, property, B, casualty, C, life, or D, health? And we'll give you a few seconds to get your entries in. Okay, and one last time to get your entry in, and we'll move on to the next slide. Okay, and not surprisingly, all lines, some effect, which makes a lot of sense, with a heavy emphasis on health, which I would tend to agree. That makes sense to me as well. Okay, and back to Neil.
Thank you, John. So let's turn away from the financial crisis a little bit and start applying those lessons to the current pandemic. So we've all seen the headlines: governments asking for new money, people being really generous in helping their neighbors. What are some of the possible outcomes that we're going to see? And I think the main thing is that the only certainty right now is uncertainty. We really don't know what's going to happen. I do know that people are more cautious in dealing with other people. There's distancing, less travel, telecommuting, the potential for more crime, although right now what we're seeing is more cyber-type scams. But one thing I'm very grateful for is you're seeing more and more charities as neighbors are reaching out to help neighbors. We talked about this a little bit before, but in the greater economic environment, one of the biggest impact that we're going to see is going to be on government. Certainly the federal deficit is going to go up with the stimulus package and the drop in revenue. And they're still debating today whether or not to give out more money to try to stimulate the economy. So we'll see how that goes. But there's a debt that has to be paid there. We're going to see state deficits go up with tax reductions and the demands that are placed on them for welfare and social services. And I know there's going to be talk of it. Let's see what happens. But whenever you see something like this, you usually hear the word reform come out, and usually that means that some kind of change in how government's going to spend money, particularly on employees, going forward. So John, I'm going to turn it over to you for a minute to talk about some more of the economic outcomes.
Yeah, very good. Thanks, Neil. So in this next segment, what we're going to talk a little bit are go into a little more depth into what are some of the economic outcomes that we think will come out of this, pandemic, out of this crisis. As Neil's already said, a couple of different times, there are many unknowns. Nobody has all the answers. But the thing that I would, present to this group is that we as examiners, analysts, maybe in some ways we're in the fortunate situation. We don't have to have all the answers, but we do have to think very critically, and we have to be willing and ready to ask good questions. And then we get those responses back from the insurers and ask maybe more good follow-up questions with a real goal of understanding and thinking critically. So as we go through some of these potential economic outcomes that are being discussed in the news and things like that, we want to kind of reflect on each one of these and think, how should we think about this critically as we ask questions and try to understand how this situation will impact our insurers? So, first item that comes to mind here is retail, devastation, and it is a bad sector for the economy. Even before this pandemic, the retail industry was already hard hit because of the sort of the prevalence of online retailing, and it's only gotten significantly worse with this pandemic. It accelerated trends that were already in place. When you look at the news, you're already going to be seeing retailers that are hit. Previously it was maybe Sears, Kmart were in the news, but now it's names like Nordstrom, J. Crew's, Kohl's, my personal favorite, Joseph Banks. They're all in the news for potential either bankruptcy, or restructuring. It might be that these names don't necessarily go away, but some kind of restructuring. They're having financial difficulty. Again, this could impact investments, can impact our companies in a number of ways. Also, lower product demand. We're seeing that across the board. Now, of course, there's some items that seem to be in more demand. There's always like the toilet paper issue or whatever, but there are other items that the demand is much, much lower. For instance, I just saw a news report the other day about Nissan having cars that they could not unload out of LA Harbor, so they're leaving them parked on the ship without bringing them in. Strong sign of lower demand that they're having to leave them parked on the ship instead of bringing on over to us. Another big item too with lower demand, which is obvious to us, especially those of us that previously spent a lot of time on the road, is airline travel. Of course, travel is way, way down. Aircraft are being parked in the desert, sort of mothballed, waiting for things to come back. Again, much lower product demand. And a strong emphasis when we think about investments, looking at emphasizing strong balance sheets. The real emphasis on balance sheets gets talked about a lot, and there's a little bit of a scary side to that, because when people say they need a strong balance sheet, what they're saying is the company needs to have a pretty strong cash reserve to be able to make it through this dip, to survive, to get to the other side of this. So these are some things that we are hearing about a lot in the news. These are things that are going to be impacting our companies and impacting their investments. Again, we want to think of all these things kind of, critical thinking. How could these things impact our companies as we consider them? Moving on to other possible economic outcomes that are being discussed a lot in the news. Decreased international trade. An obvious piece of this decreased international trade would come from things like I mentioned before, travel. We're not traveling, so we're not staying in hotels. We're not renting cars and things of that nature, and we're not traveling as much. But it's actually much deeper than just the travel aspect. I think that there's a lot of discussion about the need for resilience, the need for a stronger, maybe even internal supply chain. And what this gets to is that previously we've taken advantage of very strong efficiencies in the world economy, where we could go to other countries around the world who could produce a product maybe of greater value at a cheaper cost, but it has come at a cost that we maybe did not fully realize. And that cost is that when the crisis hits, can you get the surgical masks from some other country from around the world in the same way if it were locally sourced. And that's come up in other areas. I mean, we've seen it with the face mask for health workers. We're also starting to see it with some electronics parts, laptops, and things like that. So there's going to be supply chain changes, I think, with a gear toward resilience. Companies saying, you know, maybe cheaper is not always the better. We also need to be sure that we can just always get the product. Another huge economic outcome, and this is kind of a difficult one, is the reduced workforce. So many people are out of work or are not working as much as they would like to as a result of this. That's going to have big impacts. I would say, just to take a moment, I think we in the regulatory industry are somewhat, have a fairly good situation. Our work has continued very strongly, but for many around us, that is just not the case. I live in an airline community near the Atlanta airport. Many airline people are furloughed, not working. It's even hitting healthcare workers the same. You know, obviously restaurants, retail, all these many segments are being hit hard. How does this has other impacts on our companies too? Because these people that are out of work, they're policyholders who may not necessarily continue their product. They may ask for a cash surrender. They're going to impact the investments of our companies. So our companies have many interactions with these people that have been laid off, and it's going to have potential impacts on our companies. I would say too that with many of these items, when we say a certain sector of the economy or a certain area is being hit, we have to also look to default risk too. Could there possibly be a default on some of the obligations that are made to our companies? Our companies are big, you know, they loan money. If the economy is disrupted, will some of those investments maybe have experienced defaults? Other, maybe more obvious insurer outcomes, stock losses. Probably, you know, many in this group, just like Neil and myself, when the stock market started going down, the first thing we did was we started looking at some of the companies we had been following closely and immediately started saying, you know, well, what if they had to do an annual statement here, you know, at March the 15th or March 20th or whatever? How would this company look? And it was a little scary. Luckily, the stock market has come back a little bit. Of course, the other obvious one that we touched on a minute ago is the possibility for bond downgrades, other than temporary impairments, things of that nature, by the investments that our companies hold. And it's also not just should they, in the event of a total like bankruptcy, but maybe there would just be a downgrade too that could also affect our companies. Many insurers have direct investments in the real estate market, or they have investments in mortgages. They could be strongly hit by defaults, or companies that just could not pay their rent. And as we all know, municipal bonds are not immune either. Municipal bonds, various municipalities, local governments, state governments, they're all suffering as well from the reduced tax revenue in these areas. So it's very, very extensive, the possibility of things that could happen here. And I think where this kind of leads us is that as we think more, the things we've talked about so far have been kind of near term, like, you know, one thing happened, how would it impact our company? But I think we also have to take a slightly maybe futuristic look as well and look forward and say, okay, when the pandemic is over, is there going to be a new economic environment that's going to emerge? And if so, what is that new economic environment going to look like? And then thinking critically, how is it going to affect our company? And is our company that I'm looking at, whether I'm examining them, I'm their analyst, how is it going to impact them, and are they prepared for that? And things to think about. And again, this is a big area, no one right answer, but just things to be thinking and good questions to ask is, you know, we've talked for years about the difficulty that the low interest rate environment causes for our companies, particularly those with long tail liabilities. We think first of our life insurers. It's also our med mal, our workers' comp. So what happens if this situation causes the low interest rate environment to extend even longer? What if it makes it even go lower? You know, there's even some people that occasionally call for negative interest rates. So these are very dramatic possibilities. We don't know what's going to happen, but it's just questions to ask, things to think about. How would it impact our company? Neil mentioned earlier too, the fact of all the government spending and the possibility of increased tax rates. Big impact potentially on our companies. First, there's the possibility of an increase in the corporate tax rate to pay for some of these stimulus bills and things that are being done in our economy. And we just saw the reversal of that a few years ago, so it could possibly unwind some of those changes. In addition, personal rates could go up too, which could have an impact on the way people buy products, and especially some of our insurance products that do have a tax element to them. And then there's always inflation too. You know, it depends on who you talk to, but some people may say we're looking at deflation, some may say inflation. So it's kind of an unknown which way it's going to go, but it's something to think about and to pay attention to see what's happening in that area as we think forward and how our companies should be positioned for these things. And again, the real thing here is there's no one right answer, but it presents many good questions for examiners and analysts to ask as we try to better understand how these things are going to impact our companies. Then moving on to the various product lines themselves and how they may potentially be impacted. You know, I want just to comment here, the next few slides are really kind of a summary of a much more extensive COVID-19 impact session that was done by Risk and Regulatory back on April 22nd. Maybe some of you were able to catch that session, but if you didn't, there is a recording of that session on our website at www.riskreg.com, right down at the bottom left-hand corner, and you can click on that and catch these same thoughts in more detail. What I'm going to do now, though, is give you kind of a high-level summary of some of the things that were covered at that point. So, when we talk about casualty products, how would they be impacted? One of the first things that comes to mind, it's been in the news a lot, business interruption coverage, loss of use. The big thing here, and just the sort of the short story, is that many of these products would have had an exclusion for pandemics, but there have been some who have called for giving coverage even in the event of a pandemic. And the insurance industry would look at that as even potentially retroactive coverage, something they did not underwrite for. So that's going to be big in the news. It's an issue that's yet to be decided and could be very significant for our carriers if pandemic were considered to be not an exclusion for those products. Workers' comp is another one with huge potential implications as a result of this. The big thing here, I believe, is one of if occupational disease, or more specifically, if COVID-19 could be a presumptive coverage, if it could be a presumptive benefit, potentially for people like first responders, meaning if you're a nurse or a doctor and you get sick with COVID-19, then would you be covered under your workers' comp policy because it was as a result of your job? And then when we think casualty products, we also have to think about liability litigation. Anytime there's this much turmoil in the economy, that's going to lead to potential litigation that could pull our carriers into that to pay for some of those things. In addition, more specifically thinking about a coverage, say med-mal, again, the turmoil in the healthcare industry could easily lead to a spike in med-mal claims as well. When we think about life products, this is probably the one that first came to mind when we think about the increased deaths that could result from COVID-19. We think first about deaths, and that is an outcome, although I think it's maybe not as bad as we may have first thought for a couple reasons. One is some of the deaths may be somewhat focused at the older ages, and that the older ages will have some offset because, as you know, we have a reserve buildup. So we already have a fairly large reserve for those insureds at older ages, so that helps a little bit. That said, though, we do expect to see an increase at the older ages and maybe even in some substandard products. And the second bullet here, pricing and underwriting uncertainty, I think that's got to be one of the bigger areas here, is that all of our life carriers are probably rethinking some of their underwriting, especially for people that may be applying for insurance today. Again, good questions to ask. And when we think life insurance, we have to think immediately to our asset liability matching. How are we doing with our hedging? And I think what comes of this is anytime there's so much turmoil and volatility in the stock market, it's going to affect our asset adequacy work. It's going to affect our hedging, and the hedges may, if nothing else, just be more expensive because of the volatility. And then lastly on this slide, we have to think too that as people have less money, we've talked about a variety of reasons why people may be less likely to spend in this environment, is that we could see a slowdown in sales of products. Premium volume could easily go down, and as we go into a weaker economy, people may also have increased cash surrender values as well. Any of these things could lead to a potential, run on the bank or liquidity situation if a company were not prepared for it. So again, just things to be thinking about. And then when we get to health products, that's where we, COVID-19 is a health issue. It does have significant impact on our health product lines. One of the first things that comes to mind to me, because I do work a lot in the actuarial area, is the unpredictable claims expense with all the things that are going on with our claim cost. If you think about the fact that we're having a change in the mix of claims, elective surgeries are not happening, but things are being shifted to the COVID-19 claims. We're having delays in people actually having procedures done. All those things, when we start thinking about our development factors and how we're going to predict this year's reserves based on patterns that we experienced in past accident years, past loss years, it's going to be very different. So there's going to be a lot more uncertainty around the reserving process as a result of all the changes that are happening in the industry. Also, health insurers have a close relationship with providers, and there's so much disruption in the provider area. Providers, many of which some are very busy because they're involved with COVID-19 services, but others are not having nearly as much work and are not able to perform the services they normally do because of all the resources going to COVID-19. This could lead to potential issues down the road in network adequacy. Also, there's a lot of risk sharing in many of our managed care products, and anytime that the providers are having an economic difficulty, it could relate right back to our insurers who are sharing risk with them as well. Another outcome we expect to see, too, is possibly more liberal use of telemedicine. And we're seeing that more and more today. How will that continue in the future? And how will that impact our insurers as we go down the road? And then one last item I wanted to mention here, too, is that we're even seeing carriers like our casualty carriers, automobile coverage, are giving back premium to rebates to their policyholders as a result of the lessened claims because people aren't driving. We're even seeing health companies such as United Healthcare who are giving credits back to their insurers because of their reduced claims. While this is a good thing for consumers, as an examiner or analyst, we have to look at each of those things as well and think for a moment, is this the right amount? How's this going to impact our company? Is it going to cause any problem with liquidity and things of that nature? Or possibly, did our carrier rebate enough? Did they credit enough? Will they have to do something in the future if they haven't done it already? So a lot of questions come up around this area as well. And that brings us to our last polling question here. Question number 5. Which risk management area do you think more insurers will revisit based on the COVID-19 pandemic impacts? Do you think it's A, investments, B, pricing and underwriting, C, operations, D, strategic, or E, other? Okay, and I'll give you just another second here. Okay, and this is a perfect answer right across the board. That's exactly right. I would say it could hit investments, pricing, operations, strategic, even other. I think there's room for other out there as well. So I wanted to leave you with one last thought here. This is a quote from Albert Einstein where he says, "Learn from yesterday, live for tomorrow, live for today, and hope for tomorrow. The important thing is to not stop questioning." I thought this was just so appropriate. We're trying to learn from yesterday, and the important thing is not to stop questioning. Our job as examiners and analysts is to really try to just understand these situations, how it's going to impact our companies, and ask good questions, get the answers, and ask more good questions, all with the goal of understanding your company to the best of your ability. On the behalf of Neil and myself, we appreciate the chance to meet with everybody today. Good session. We have a number of questions here as well, and we will be answering those questions remotely, as in we will send out the answers to everyone following this session. And if you have other questions, my contact information, as is Neil's, is on the slide here. Feel free to reach out at any time. We look forward to talking to you. Thanks again for joining us today.